It could be like $1,000 for silver to get to 20%. Why are those banks short the silver market? Okay. I think it's going right to 15, 1 to 15. Okay. So let's say if the gold price is 4,500, which is near, silver should be at $300. Yesterday, overnight, there's probably something like 70,000 new ounces demanded. That's 70, that's $200 million, 200 million in a day. You know, the Chinese have said that as of Jan 1st, we're not exporting any silver unless you get a permit. And they were big exporters, okay?
Right.
So that could be 50 or 100 million ounces that's not coming out of the market. And they're the biggest users of silver. You know, when it comes to like solid state batteries, it's all Chinese dominated. Don says, look, at my price for silver is 150. This stock over here, Silver Junior, that's going to go up by 10 times. Oh, guy, Samsung develops a battery that charges in 9 minutes.
Right.
It goes 900 kilometers. Can anyone figure out why that's a world change? They use a kilogram of silver in this solid state battery. You know, I've always been a great proponent and believer in Michael Oliver's work, who does this momentum structural analysis. You've interviewed him, I'm sure.
Yeah. Oh, he's a great guy.
And that guy's been as right as rain. And we might be supporting each other because, you know, he says, oh, that guy, Eric Sprott, he really likes silver. It's going to $200. And I said, well, I really like that guy, Michael Oliver, because we're probably reading from the same notebook, right?
Just going around in circles.
But I go at it from the point of view that I've always believed that silver was manipulated big time for 50 years, okay? And I don't need to justify, you know, 10 or 12 major banks have been short the whole market for that whole time.
Yeah.
Why are those banks short the silver market? Okay. Yeah. Is there a reason for that?
They're hedging.
No. You know, they're not hedging. We know that. Nobody hedges anymore. There was an excuse 20 years ago. So I can believe that it's gold silver should go back to 15. Okay. It's only mined at 8 to 1.
Right.
It's in the Earth's crust at like 10 or 11 to 1. Why the hell should it have traded at 100 to 1? And it's already down at what, 67, 68 to 1?
This is where a polite market narrative quietly breaks down under basic arithmetic. Eric Sprott isn't making an emotional argument. He's pointing to a structural inconsistency between geology and pricing that has persisted for decades. As analysts like Michael Oliver have documented, concentrated short positioning by a handful of banks distorted silver's price discovery while being framed as liquidity. Meanwhile, silver is mined at roughly an 8 to 1 ratio to gold, yet traded near 100 to 1 for years. A mismatch markets usually don't tolerate forever. For investors, this matters because structural distortions unwind slowly, then suddenly. And when they do, they rarely stop at fair value on the first move. What Eric Sprott says next explains why this imbalance may already be correcting.
I think it's going right to 15, 1 to 15. Okay. So let's say if the gold price is 4,500, which is near, makes the calculation easy. Silver should be at $300. That's where it should be. That's without a physical shortage, okay? Now we throw the physical shortage on top and the shortage of silver stocks to buy. I mean, the runway is so wide open that I can see nothing but clear sailing for silver. It might have times when it gets beat up, and I always find it hilarious watching silver trade on the COMEX, and you know they have these 10-minute bursts to the downside.
Yeah.
Bang, 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 bang.
Yeah.
And a half an hour later, it's right back up there.
Mm-hmm.
What is that guy trying to do? Is he setting off stops or something? Or I don't know what they're doing.
Yeah.
But they never win that thing anymore when they're banging it down. They don't win those things. They lose every damn battle. I don't know how it works out for them. You know, maybe they are setting off stops and they're buying, you know, getting guys to stop out on their longs, but it never seems to hold together.
This is a classic example of price targets sounding aggressive until you actually run the math. A 15 to 1 gold to silver ratio isn't radical. It's closer to historical norms than today's pricing, especially if gold sustains higher nominal levels. What's changed is the market microstructure. Repeated COMEX sell-offs fail to stick, suggesting paper pressure no longer overwhelms physical demand. As Eric Sprott and LBMA data have shown, above-ground silver inventories are thin relative to daily turnover. That's a warning sign for leverage shorts. For investors, failed breakdowns often precede trend acceleration, not exhaustion. The next section explains why recent price behavior already contradicts past silver blow-off tops.
I mean, if you did that for a living you're in the investment business, I don't think you'd be in the investment business very long.
Right. Well,
So,
I wanted to ask you about that because you mentioned gold breaking out to new all-time highs back in March of 2024, and it has since doubled, right?
Yeah.
Silver broke out to new all-time highs back in October, and it's kept going up. The question back then was, well, it's just the same, just like 1980 and just like 2011, it goes to 48, and then it's going to go straight back down. The fact that it didn't go straight back down, Eric, got to be telling you something.
Yeah. There's no analogy there, right? We have done so differently this time. And of course, any student of silver realizes what's happening here when you see the nomination for deliveries almost every day in the COMEX, physical delivery, new. Like I think yesterday overnight, there's probably something like 70,000 new ounces demanded. That's 70 minutes, $200 million, 200 million in a day. Some guy comes in and buys 200 million of physical silver on a COMEX. I don't know what happened in the LBMA because you never seem to know what's going on over there. And of course we got the Shanghai exchange.
This is the moment where historical analogies quietly stop working. In 1980 and 2011, silver spiked and collapsed because physical demand evaporated. Today, deliveries are increasing after breakouts, not disappearing. COMEX delivery notices rising alongside price is unusual, and signals real buyers, not momentum chasers. As Eric Sprott has noted repeatedly, sustained physical drawdowns change risk dynamics for both exchanges and shorts. For everyday investors, this means volatility doesn't automatically equal fragility anymore. When price holds despite supply stress, downside risk compresses while upside risk expands, and the global angle he brings in next makes that pressure even harder to ignore.
And of course, silver went up 5% 2 days ago, went up 1% overnight tonight. It's been a very important market. We took their inventories from like a million kilograms down to 500,000 kilograms. It's inched back up here to, I don't know whether the number is 700,000 or 800,000, but I noticed it went down yesterday. But the Chinese, and this is a point, have said that as of Jan 1st, we're not exporting any silver.
Right.
Unless you get a permit. And they were big exporters, okay?
Right.
So that could be 50 or 100 million ounces. It's not coming out of the market.
That I've got to jump in and segue in another question here, because that was another one that we got. How much do you think Shanghai, is now the price maker versus, where it always had been the paper markets of London and New York? Is now China the overnight trade that starts currently at 8 o'clock Eastern every night?
Yeah.
Is that the market? And then London, New York is just reacting to that now.
Well, there's no doubt that, as you know, both London and New York, until a few years ago, hardly ever had a delivery.
This is where pricing power quietly shifts away from Western paper markets. When China restricts silver exports, potentially removing up to 100 million ounces from global supply, that's not a headline, it's a structural shock. Shanghai has always emphasized delivery, unlike London or New York, where contracts rarely settle physically. As Bloomberg data has shown, Asian demand increasingly sets overnight direction, with Western markets reacting rather than leading. For investors, this means paper-driven sell-offs lose authority when supply is controlled upstream. Next, Eric Sprott talks how the real risk now isn't volatility. It's assuming yesterday's market mechanics still apply tomorrow.
What's a delivery? They never delivered anything.
No.
Okay. COMEX and the LBMA didn't have deliveries.
Yeah.
Well, of course, Shanghai's always been, it's a delivery market.
Mm-hmm.
And of course, they're the largest provider of silver, and they're the largest consumer of silver, although the Indians are giving them a run for their money, okay? That's going to be the nexus of where things will be determined in the future, for sure. And they're the biggest users of silver. When it comes to like solid state batteries, it's all Chinese dominated. I know your president's trying to get some plants built over here. We'll see whether that works or not. But I think that the fact that people realize you got to shift from paper to physical, that that will provide a real buttress for the gold and silver if the market starts fading. So even yesterday, when the market got beat up pretty good, gold and silver did okay. Silver was way down and came up, and gold went up. Today, we've got the markets doing very well. And of course, now gold's starting to run here. Silver, which was down, is almost back to break even.
This is where the illusion of Western price control quietly collapses under physical reality. For decades, COMEX and LBMA set prices without delivering metal, while Shanghai required actual settlement, a structural difference most investors never hear about. China now dominates both silver production and consumption, and according to Metals Focus, Asia accounts for over 60% of global physical demand. When price declines fail to break metals during broader market sell-offs, that's a signal paper. Leverage is losing authority. For portfolios, this means downside shocks may no longer flush physical holders the way they used to. And next, Eric Sprott talks about how risk should be measured going forward.
So I think that people will see through this and hold in there, because, you know, if they're trying to go from 1% to 2%, that's a lot of buy-in.
Right.
I like to think that maybe I already own 0.1 of 1%. I don't, by the way.
They're going to come for yours.
And you ain't getting it.
The old Charlton Heston line about they're going to take my gun out of my cold dead hands. Eric's
but, you know, the people that own gold and silver stocks aren't sellers, okay?
Right. Yeah.
Forget about it.
Yeah. Well, and again, gosh, Eric, that point, that was one of the days that gold shot higher. With that Morgan Stanley idea that the new allocation shouldn't be 60-40, like 60% equities, 40% fixed income. It should be 60-20-20 with 20% in the precious metals. How much, just elaborate as to how much investable assets that is, if that happens.
Crazy. I don't even know how much investable assets are there in probably hundreds of trillions or something, right?
Right.
So you're probably, I'd say, well, okay, that's 40 trillion that has to go into hard assets. It's not just gold, not just silver, by the way, but that's a lot of money to go in something that probably has a market cap of 2 trillion today. I don't even know what the market cap is, but I know it's way the hell below the number it could be.
Right.
Yeah. So
this is the part Wall Street avoids because it exposes scale risk. A move from 1% to 2% allocation into precious metals sounds small, but across global investable assets, estimated by Eric Sprott at over $300 trillion, that shift implies tens of trillions in demand. Meanwhile, the combined market cap of gold and silver equities remains near $2 trillion, creating a severe liquidity mismatch. As Eric Sprott has warned, markets don't need full participation to reprice. Marginal buyers move price. For long-term investors, this is about positioning before allocation models change, not after flows force repricing.
But I'll guarantee you, with the price of silver at 60 on its way to 100 or 200, which Michael Oliver's suggesting might get there in the next few quarters. I'm emphasizing the word might get there next few quarters. That's not far from here, okay, guys?
Right.
That, you know, Hycroft's going back into production, okay? Or someone's going to try to take him out for sure. I might be standing at the gate holding it closed, but you know that's...
Well, let's do it. I just want to go back and do the math. You own 40% of the company and they have how much potential silver in the ground?
Well, they already have a 1.5 billion equivalent ounces of silver reserves. 1.5 billion. Okay. No, let me go there. Here we go. Okay. So at $200, they'll only have 300 billion of metal value. They'll only have 300 billion of metal value. And the market cap's 1 billion of metal value. One. Now, if it goes to 200, what would their profit be?
Goodness.
Would you give them $200? Give them they got to let's say make 150. That's 75% of 300. It'd make, what's that? 2.25 billion. It's 225 billion.
This is where valuation math becomes uncomfortable for skeptics. If silver approaches triple digits, reserve-heavy producers reprice violently because the asset base expands faster than costs. As Michael Oliver's momentum models show, late-cycle commodity runs compressed timelines, not just upside targets. A company with billion-ounce reserves priced at a fraction of in-ground value represents optionality markets routinely misprice. Investors should focus less on spot prices and more on reserve leverage and jurisdictional risk. Next, Eric Sprott explains why governments may actually accelerate, not block, this transition.
They'd make 225, I got to tax it. They'd make 150 billion. They'll earn 150 billion. And the market cap's 1. Well, what's the upside here, guys? Well, let me think. Would that be like 150 times, maybe? From here?
Safe to say you like this one.
Hey, in Corchers.
Sounds like I can sense you're enthusiastic about that one, Eric.
There's a bunch of great silver deposits, by the way. So, for example, Discovery has Cordero.
Right.
That's Hold
on, let me back. I got to stop you there.
Yeah,
Jump in, because I had somebody ask me. See, ask Eric if he's worried about Discovery and Cordero and how long it's taking to permit or whatever.
No, I'm not worried about it. I'm pretty certain that if I was the Mexican government, I'd want Cordero into production.
You would think.
Think of the money we'll be making.
Yeah.
With the taxes and the royalties and whatever else these governments collect off of these guys. No, and they've given out quite a few permits already. And of course, Cordero is a big, complicated one. It's big. But I'm pretty certain they'll get it.
This exposes the contradiction between political fear narratives and fiscal reality. Governments talk tough on mining, yet depend heavily on royalties when commodity prices rise. In Mexico alone, mining contributes billions annually in tax revenue, making large projects economically irresistible. As Eric Sprott has pointed out, permitting delays usually resolve when prices force urgency. For investors, this reframes risk. Delays don't destroy value. They often concentrate it. And when permits arrive during a supply squeeze, upside tends to be non-linear rather than gradual.
There's a company owns the Metates mine, Chesapeake Gold. That's another huge one. I don't know whether it's 20 or 30 million equivalent ounces of gold. And I probably could do it in silver too, but I just don't have it in my mind. And the stock trades for nothing. Now, there's been some dispute down there about the Mexican government wanted to take back some of the property. And I don't know how that dispute's going to work out. So I can't move into it as much as I am with Highcroft. I like what's going on in Nevada. They already have permits. They've already got the leach pad. They've already got all sorts of infrastructure. They got roads there and buildings there and repair depots and shit like that. So they're when they start up, they'll start up fast.
They
might be 6 months.
They just got to get past you at the gate with the lock. And
people are still thinking silver's at $25 or 30.
Yeah.
Well, folks, it's double that price. Okay.
Right.
These stocks they'll all be multi-baggers. By the way, I like this Don Durrett guy. Okay. Did you interview Don Durrett?
I've not, but I know who he is.
He's but Don, I love what Don does because
the disconnect here is not geology. It's investor psychology still anchored to outdated silver prices. Assets with permits, infrastructure, and sunk capital are fundamentally different from paper stage explorers, yet markets price them similarly. As Eric Sprott has repeatedly noted, permitting is often the single largest de-risking event for miners, and Nevada remains one of the top-ranked jurisdictions globally. If silver has already doubled while equity valuations haven't moved, that's a lag, not a coincidence. The real question investors should ask is how quickly capital reprices once production timelines shorten.
Don says, look, at my price for silver is 150. This stock over here, Silver Junior, that's going to go up by 10 times. Hey, he's right. At 150, it's going up by 10 times. Giddy up, go. Quarters, 200. Quarters, 2 quarters, 200.
Is that the best opportunity, you think, as we round the corner into 26? Is anything related to silver?
Sure, exactly. Yeah. How could you've never seen anything change quite like that? That has so many investment opportunities. Okay. Yes, we've seen the price of lead go up or the price of nickel go up. There are only 4 nickel companies you could buy, right?
Right.
We have probably 100 silver companies that could benefit by this, where the grade was too low or the deposit's too small. Well, a 30 million ounce deposit at $200, that's worth $6 billion. Now, $6 billion.
Yeah.
And their stock's probably trading at 52 million.
Right. Right.
I own a few of them.
Well, this sure has been fun. I know you got to go, so we're going to call it a day here.
Yeah. No, I can't call it a day yet. I haven't mentioned one thing.
What's quietly highlighted here is optionality on a scale most sectors never experience. Unlike nickel or uranium, silver has breadth. Dozens of companies positioned to reprice simultaneously. A 30 million ounce deposit valued at today's prices versus triple-digit silver creates valuation asymmetry that long-term investors look for. As Eric Sprott often explains, markets don't reward certainty early. They reward positioning before consensus shifts. The risk isn't owning too early. It's ignoring how fast re-rating happens once prices force recognition.
I got to mention the solid-state batteries, okay?
Oh, well, okay.
And I think that this solid-state battery is going to be so dynamic for the price of silver, and we haven't even seen 1% of the impact in silver yet.
Let's tie that back in then as a final point, because it gets back to what are the risks. And again, yeah, I mean, if we knew for sure silver was going to be 200, I mean, we suspect, that it's going that way, but you never know what can happen in the world. Yeah. But work that battery in, because that news has been bubbling up again.
Okay.
And everything else that from a fundamental, I mean, this isn't just, we're chasing a dot on a screen and counting waves and all this, mumbo jumbo. Fundamental reasons why silver is going to keep going.
Yeah. Well, Samsung develops a battery that charges in 9 minutes. Can anybody figure out why that's a good thing?
Right.
It goes 900 kilometers. Can anyone figure out why that's a world change? And they use a kilogram of silver in this solid state battery. By the way, they use manganese too, which I'm a big owner of, not the metal, but the companies. And they say if that could capture 20% of the electric vehicle market, it would consume all the silver produced in a year.
This is where demand math quietly breaks the paper pricing model. Bloomberg has already flagged battery innovation as a primary driver of future metal shortages, yet silver demand forecasts barely reflect it. A single technology consuming a kilogram per unit turns silver from cyclical metal into strategic input. If 20% EV penetration absorbs annual supply, then inventories, not sentiment, set prices. Investors ignoring industrial pull risk misunderstanding why silver may decouple from traditional commodity cycles.
My goodness gracious.
Yeah.
And that's just that. That's just that battery. That's not solar panels and electronics.
Is it any wonder that these Asian countries keep buying these materials?
Right.
So I think that's a big change that's coming. And they're going to be starting to produce these things, I think, for consumption in 28 vehicles. So that's 27 production, which means maybe buying the metal in 26 to make sure you got enough. And, was there a shortage? Yes, there is. Well, you're screwed already, okay? So you better find a way, Mr. Samsung. Well,
and that's another thing you wait on, right? At some point, Mr. Samsung say, I think I'll just buy that mine.
Maybe I should buy that Highcroft.
Right. I don't want to jack around with, I got to have silver. It's one of 1,000 things I got to have to make my product. And I got to have all 1,000. I don't need 999.
Yeah. And I can buy this for cents on the dollar.
Right.
Today.
Yeah. No, again, it's such a compelling story. And and when you mentioned too, the banks that have always set the price by making the market and hedging, Eric,
right.
If they are suddenly reluctant because they know that the silver just isn't there to keep feeding it in the physical market. And we've got to find sellers of existing silver to meet the buyers.
This is the moment when industrial logic overrides financial engineering. Corporations don't hedge scarcity. They secure supply. We've seen this before in lithium, where automakers acquired mines outright once shortages appeared. If banks hesitate to intermediate because inventories are thin, price discovery shifts violently. For investors, that's when equities tied to real assets outperform financial proxies. The timeline matters. Procurement happens years before headlines acknowledge shortages.
Yeah. Well, it's funny. I always say the banks were the guys only selling. Well, what happens when the banks become the buyers? Who the hell are they going to buy it from?
Yeah, then what's left?
To cover their short. Anyway.
This is the question that exposes the entire structure. For decades, bullion banks controlled prices through paper supply, not physical availability. As Eric Sprott has long argued, concentrated shorts only work while metal is accessible. If banks flip from sellers to buyers, the market has no shock absorber left. For investors, that's not a bullish narrative. It's a structural break that historically leads to disorderly repricing.